Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Thursday, the 19th of June, 2025. So as usual, before we start, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick look at what has taken shape yesterday, which is very important, especially that yesterday we have the conclusion of the FOMC meeting and also the latest guidance coming out from the US Federal Reserve, and how does it impact the various broad-based cross-asset classes intraday movement, and as well as any other important economic data release, and as well as news flow that has taken shape yesterday and in early Asia session today before the start of our daily dose at 11 a.m. where it could potentially create a significant movement on an intraday basis for those broad-based cross-asset classes that we cover on a daily basis. Then thereafter we should actually move on to the short-term intraday technical outlook on these broad-based cross-asset classes, which is the major dollar pair, the major stock indices, and the two key commodities market, the gold XAU/USD, and as well as West Texas crude oil. So let us start with the US Federal Reserve meeting decision outcome yesterday. So let me share my screen so that you guys could have a better view of the chart. All right, over here. Okay, so basically what came in terms of the decision remains unchanged. So the Fed holds rate again for the fourth consecutive session. That means they have been maintaining interest rates since the start of this year. Last cut only in December 2024. Then thereafter it maintains the rate. All right, and also yesterday it was the release of the dot plot. So the dot plot is actually basically a median projection done by the Federal Reserve officials in what's their view and opinion in various key economic metrics, and as well as the Fed funds rate expectation that it will end in the short to medium term. So later I'll touch on the detailed dot plot figures for you guys, but in a nutshell, they still see 2 rate cuts by year end. So this pendulum doesn't change. But what's interesting over here is that the latest dot plot sees fewer cuts in 2026 and 2027. The Fed also cuts growth forecasts and boosts inflation outlook. So this particular we call it a projected view on the economic situation in the US indicates stagflation risk. That means, i.e., inflation trend increase, growth trend slow down, and primarily due to the reason of tariff increases that will likely push up prices during Powell press conference. All right, so in the nutshell, what we could see over here is this will be the dot plot. So let me share with the dot plot. All right, so this is the Federal Reserve dot plot. So let me start with, okay, I believe that, let me expand it bigger so that you guys could have a better view on the screen. I think this should be the biggest that I can go. Okay, maybe slightly bigger a bit. Okay, cannot. It will truncate the whole picture. All right, yeah, so this should be the better one. All right, so let's focus on the median rather than the central tendency. All right, so the median is the middle because we have a slew of Federal Reserve official forecasting, so we take the middle of them. So basically this one here is what was projected in March. Right, so the dot plot in a nutshell is released every 3 months. All right, so put it away that every quarter the Fed will release this dot plot. So yesterday they released the latest one. So previously the Federal Reserve officials has a view that by the end of 2025, US economy will grow by 1.7%. This time they revised the growth downward to only 1.4%. For 2026, they're looking at 1.8 so it will only be 2 basis point lower, 1.6, and maintain the same trajectory as in the previous March projection, 1.8. No change for 2027 growth forecast, 1.8, and the long term or the longer run forecast in US GDP growth on an annualized basis. This is a very, very long run. They expect to grow at 1.8%, very similar to the same forecast that they made earlier in March. All right, and now look at the core PCE inflation. So that strip out energy prices and food prices. Previously in March, they project it to be 2.8. Now they pull it up by 3 basis point increment, 3.1%. Similar for March projection in 2026, 2.2. Yesterday's projection for core PCE increased to 2.4%. In 2027, March projection 2%. Yesterday projection for core PCE was raised by 1 basis point, 2.1%. So very clearly, this is the Feds are pretty much concerned about stagflation risk in the US. So that means, i.e., GDP growth will tend to slow down in 2025 to 2026, and core PC inflation will start, the trend will start to increase upwards from 2025 to 2027. And if you look at the Fed funds rate, so this is the absolute number. So based on the absolute number, we can have an implied expected rate cut projection. All right. So previously in the March projection, the penciled it at 3.9%. So no change for the Federal Reserve Fed funds rate. So they expect 2025 to be the same at to end the year at 3.9%. So if you take 3.9%, looking at the current Fed funds rate of 4.25%, that gives us an implied potential of 2 interest rate cut of 25 basis point each. All right. And if you look at the March projection, previously they expect 2026 Fed funds rate to end at 3.4%. Now they expect it to end higher at 3.6%. All right, similar for 2027. Previously, they project the Fed funds rate to be at 3.1%. Now they expect it higher. Yesterday, after the yesterday's latest dot plot projection, by 2027 it will end higher at 3.4%. So what you could see over here, if you look at this path, that means 3.9% to 3.6%. So the latest trajectory, right, the Federal Reserve expecting is only potentially one interest rate cut in 2026 and also one interest rate cut in 2027. So it's a rather hawkish look. I would say that a rather mild hawkish view that the Fed has right now, rather than a dovish view over here. So I would say that yesterday's monetary policy meeting by the Fed is not a dovish hold, but rather a hawkish hold instead. All right. So because of the stagflation rate, so because of this hawkish hold coming into play, that could tighten liquidity in the US. That means in the longer term, interest rate may get higher. So with longer term interest rate getting higher, it could potentially trim net profit margins or reduce net profit margins in US corporations. So that could be a kind of a headwind for earnings growth expectation in the US. So what we could see is that yesterday's US stock market actually sold off into the close. So initially it opened, tried to push up, but after that the momentum starts to decline as the Federal Reserve meetings outcome was released at 2 a.m. Singapore time, and it thundered all the way while Powell is speaking between 2:30 a.m. and 3:30 a.m. Singapore time. All right, so if you look at net overall, rather weak movement in the US major stock indices, where the SPX erased earlier gains. The similar for the Nasdaq 100 as well. The earlier gains has been totally removed off on the intraday basis, and the Dow Jones Industrial Average underperformed with negative 0.10%, and surprisingly, the Russell 2000 still managed to inch out a gain of 0.5%. But you look at the trend of the Russell 2000 on the intraday basis. Give me a minute, I think it's hang again. All right, it also thundered downwards towards the end. All right, that means a rather weak closing performance. All right, at the start it burst up, then towards the end it tried to close lower. All right, so not a really that fantastic movement on the Russell 2000, despite it managed to close in the green by the end of yesterday US session. And also because of this tightened liquidity condition in the US, that actually that means we do have a less we call it dovish Fed. tightened liquidity condition in the US, so that could potentially see short-term interest rate rising in the near future. So that created a dollar strength coming back into the picture, all right, against the rest of the world. All right, so what I could see over here is that we start to see the dollar strength rising. So this is the 5-day rolling performance of the dollar against the major currency. So right after this 2 a.m. mark over here, the dollar actually rose across the border over here as we are speaking. And you look at the 1-day performance right now, okay, the dollar is actually rising steadily. A bit of dollar strength setback that is being seen on the Aussie dollar and the Kiwi dollar as we are speaking right now, but the dollar yen continues to actually steadily increase. So later I'll share with you the short-term intraday technical outlook chart of the various dollar major pair. Right, so let's go back to the 5-day rolling performance. And if you look at the trend of the US dollar index over here, let me share with you the trend of the dollar index. Okay, so this is the dollar index. So yesterday, since the start of this week, the dollar index is able to actually be below the 20-day moving average over here. You could see my screen right below the 20-day moving average. And in today's Asia session, it continues to extend a gain of 0.21%. So yesterday it closed slightly higher at positive 0.03%. Today in Asia session, it extend a gain of 0.22% and is now breaching above the 20-day moving average. All right, so upon breaching above the 20-day moving average, if you to look at the daily RSI, the daily RSI has started to actually see a bullish divergence. All right, there's a bullish divergence that's being formed. This low, previously the dollar index low here versus this is a lower low, but the daily RSI has started to form a higher low, and the daily RSI also has broken below this former parallel descending trend line, right? That means this is something like a momentum bullish breakout. So with this momentum bullish breakout that's being seen on the daily RSI on the US dollar index, so right now we could be right for a potential dollar rebound taking shape over here. So this dollar rebound may actually retest at least in near term that 28th of May Marabuzu bearish candlestick high at around the 100.40 level. All right, 100.40 level. So i.e. in the short term there could be a risk of this dollar strength coming back into the FX market due to the technicals that is supporting this short-term dollar strength, at least this dollar strength, at least in the short-term basis over here. So one thing we got to monitor things steps at a time. So if I were to look at the weekly time frame chart of the US dollar index over here, so the weekly time frame chart of the US dollar index, the previous slide of this dollar since the start of this year has really reached the lower limit of this longer term ascending channel support from May 2011 low. So that's close to around what 20 over years of long-term circular uptrend. So if I put it in the monthly basis, are you able to see it? Right, so this is the major not even major, I would say long-term circular uptrend ascending channel from the low of May 2011, and price action has starts to hit this channel over here. And now if you look at the monthly basis, it starts to form a monthly bullish hammer candlestick formation, because we know that the month of June hasn't ended, so this candlestick may change. So if indeed the month of June by 30th by 30, I would say that by on 30th of June, we start to see this bullish hammer candlestick remaining in the same kind of we call it pattern, hitting the longer term ascending the long-term circular ascending channel support at 97.4, coupled with that bullish divergence on the daily RSI. That means potentially we may start to even see a deeper, we call it a rebound taking shape going forward from a multi-week perspective. So we are now taking things one step at a time, but we know that at least for the very short-term nature price action of the dollar index may see a push up in the first step towards 100 100.40 level. Okay, so 100.40 level is also this former descending, we call it a range support level, linking the lows of January 2023 and September 2024 now turns into a pullback resistance. All right, so that's for the dollar story. And what we could see over here is that given that the dollar story is getting more on the positive side right now from the technical perspective, and as well as from a rather hawkish whole stance that is being portrayed by the US Federal Reserve yesterday, we now starts to see the so-called the gold starts to be trading in a lethargic fashion over here. So for gold, it's still going to hold above the 20-day moving average, but can't do any can't do any sign of a rebound at this moment in time, because right now that it could be potential conflicting elements or oppositing force elements that is playing to gold. So on one hand, gold is kind of being supported by this ongoing geopolitical risk premium coming out from the Middle East. That means, i.e., geopolitical risk uptick because of this ongoing Iran-Israel conflict that is showing no sign of a clear de-escalation. But the upside of gold right now is being kept by the return of the US dollar strength in the shorter term, right? So that's why we see gold price is trading neither here nor there, very much in the tight sideways range since the start of Tuesday, right? Since Tuesday onwards. Okay, so now with that, one more particular news flow I'll share with you all is this news flow that is out in the Asia session. Just about 2 hours ago, US officials now is there's a news flow out from Bloomberg stating that they are potentially preparing for a possible strike on Iran in the coming days. All right, so right now it's getting a pretty higher chance that US will get involved in this Iran-Israel conflict. So that could actually potential see a bigger geopolitical risk premium uptick, at least in the shorter term. And with that, oil prices continues to hold pretty steady over here. So if you look at oil price, West Texas crude oil right now is actually up by 0.48%. So yesterday, it actually down by almost 1%, but it's still traded close to last Friday session higher over here. So last Friday high was at this 76.30 over here, 76.30. That was also the high that's being seen once the news came out that Israel has launched airstrike against Iran strategic assets, all right, on last Friday. So I would say that prices still seems to be pretty much bullish right now on the West Texas oil. So later I'll cover the short-term intraday technical outlook on what are the key levels to look out for. All right, so these are the key news flow economic data release that has taken shape earlier yesterday, and as well as in early today's Asia session. Right, so now let's move on to the second segment of the daily dose today, all right, which is the intraday technical outlook segment. All right, but before that, let me make sure that everything is good. Yeah, everything is good. So now let me expand my screen. All right, so let us start with the FX market over here, starting with the euro dollar. All right, so the euro dollar yesterday broke down our short-term pivotal support level 140.80. All right, in today's Asia session, yesterday it was tested, and in today's Asia session it broke down during the 9 a.m. hour mark. All right, so with that, I will respect the price action of the euro dollar. That means what we could see now is that since the high of 12th of June, is now inside this corrective decline sequence. All right, in this corrective decline sequence. So I'll be using yesterday's intraday high, just right exactly the release of the US FOMC monetary policy decision outcome and the dot plot, which is at 1:15:30, which is a pretty clear psychological level as well. Price action from this long tail candle can't break above 115.30, then thereafter starts to dwindle downwards on the euro dollar. So 115.30 short-term pivotal resistance on the euro dollar. Flip to a bearish bias on the intraday basis for the extension of this ongoing minor corrective decline. Near-term support level to watch 114.10, which is the close to a 20-day moving average. Below it potentially sees 113.60, which confluence with the 50-day moving average, and as well as the minor swing low area of 4th of June and 2nd of June, and as well as close to this minor ascending channel support that I drew from the low of 13th of May. Only a push up, a bullish breakout, and an hourly close above 115.30 will see the buyers see the buyers switching back to the bulls and invalidate today's corrective decline sequence scenario to see a recovery at least to retest last Thursday minor swing high, now forming a minor range resistance at 116.10. Okay, so that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar continues to hold above the 50-day moving average over here. So what we could see over here is that it's kind of a mixed element now for the sterling dollar. So the sterling dollar is being kept by this parallel descending trend line resistance, forming a lower high below the 50 level mark, but price action now has starts to form a bullish divergence, right? Okay, so what I could see is that lower low, but no lower low on the hourly RSI. So given that it's still holding above the 50-day pivotal support level that we have yesterday, which is that 50-day moving average that we have defined as a pivotal support yesterday, which is 133.70. But however, given that the overall dollar sentiment is still rather bullish on a shorter term basis, by just a while ago, I shared with you all the elements in the US dollar index in the first segment of today's daily dose. So I'll be more cautious for today on the sterling dollar. So from a bullish bias yesterday, I'll be switching to a neutrality stance. So neutral between yesterday's exposed US monetary policy decision outcome and the release of the dot plot, which the bulls managed to fail to have any breakthrough at the 134.80 level, come break above 134.80. So this will be my upper neutrality limit for today. So flip to a neutrality stance between 134.80 and 133.70 for today. And so given the fact that today we do have a Bank of England decision as well, so later I'll share with you what is the consensus like for Bank of England monetary policy decision when we cover the third segment of today's daily dose. All right, so nutshell, neutral for now between the sterling dollar between 134.80 and 133.70. Next up will be the Aussie dollar. So the Aussie dollar yesterday we have a bullish bias. So the bullish bias hit our resistance level as expected before trending downwards back again over here. All right, so given the fact that right now it's coming very close to the support level again at this point in time, so I would now still use this short-term pivotal support level on the Aussie dollar, because no point flipping back to a bearish bias really, because price action has really almost dropped close to the support level again. Okay, so let me change it. So it will continue to actually trade within this range. All right, so price action now has come close to the minor support level that is in place since last Friday, which is so the 20-day moving average where price action managed to survive. 164.70, so not one, pardon me, 64.70, 64.55, short-term pivotal support, maintain that bullish bias, but however, the resistance to watch out for in first step for today remains unchanged at 65.37 slash 65.45. So why 65.37 slash 65.45 so important? Because this is the upper limit of this complex range configuration that the Aussie dollar is still undergoing since the low of 24th of April this year. Right, so it tested a couple of times, one time, two time, three time, can't break above, and fourth time yesterday as well. Okay, only a clear bullish breakout above 65.45, then that will constitute a bullish breakout scenario from this 1 month, I would say, yeah, close to 1.5 months of complex range configuration to see the next near-term resistance coming in at 65.80. So for now, still expecting a kind of a range bound scenario for the Aussie dollar, but given the fact that it's coming very close to the lower limit of this minor range support that is in place since 13th of June and also holding above the 20-day moving average, we will be maintaining our bullish bias, but however within a range configuration. Okay, with two key levels to watch: 64.45, 64.55, and on the upside 65.37, 65.45. So that's for the Aussie dollar. Okay, next up will be the dollar yen. All right, the dollar yen over here. So by looking at the dollar yen, what we could see is that price action also continues to congest within this kind of range configuration as well, that is in place since the low of 27th of May, right? This range configuration. So what we could have is that yesterday the price action hit our first support level. Then upon the release of that US Federal Reserve FOMC meeting outcome and the dot plot, it rebounded. But the way it rebound, it can't break above the pivotal resistance that we highlighted, and the hourly RSI continues to be kept by this parallel descending trend line. Right, so indicating the lack of upside momentum. So because of this not so rosy or bullish RSI, or I would say still a bearish condition RSI, the hourly RSI, I'll be still having that bearish bias, but within a range configuration again as well. So looking at 145.35 as my short-term pivotal resistance level on the dollar yen. First support level to watch will be this minor range that starts to form on this Tuesday at 144.50. Only a breakdown below 144.50 may expose the 20-day and the 50-day moving average, acting as the similar next near-term support level at 143.90, which is the minor swing low area of 13th of June and 16th of June this Monday. Only a bullish breakout and an hourly close above 145.35 that would invalidate today's bearish bias scenario to skew towards the bulls, exposing the next near-term resistance level, pardon me, at 146.10, followed by 147.15 next. So that's for the dollar yen. All right, so that sum up the intraday technical outlook on the FX major FX pair. But today there's one major FX pair I want to highlight to you guys, is actually this pair called the dollar Swiss, the dollar Swiss over here. All right, so what's interesting over here is that the dollar Swiss is now also rallying as well since the low of last Friday, going to push up. But the way it push up over here, the momentum is losing strength. Okay, and also is also there's a key risk event taking shape today, which is the SMB, the Swiss Central Bank Monetary Policy Decision, that is out as well. So later I'll share with you the view of the monetary policy decision, and market is expecting the Swiss Central Bank to cut interest rate back to 0%, and some of them are also expecting the Swiss bank to adopt a negative interest rate policy again, because of a very strong Swiss that is actually causing a rather weak export growth for the Switzerland economy, which is pretty much dependent on export. But what's interesting over here, price action has really started to price in this potential cut in interest rate by the Switzerland Central Bank, and the momentum doesn't look great right now. If you look at the hourly RSI on the dollar Swiss, it starts to see a series of similar higher over here, same high, indicating the lack of upside momentum, and so fast approaching the 50-day moving average as well, which is at the 82.40 level, confluencing with the this previous range top over here from 6th of June to 11th of June. So I'll be watching 82.40 as my short-term pivotal resistance level, having a slight bearish bias on the dollar yen, and a breakdown below 81.55 will increase the odds of my bearish bias. Why? Because this 81.55 is the minor trend line support that is so far holding up this current rebound that has taken shape on last Friday. So a breakdown below 81.55 will indicate that this current rebound is more like a corrective rebound, where the medium-term downtrend phase and the short-term downtrend phase may continue to resume on the dollar Swiss, at least in the short term, exposing the next support level on the intraday basis at 81 figure next. However, if price action starts to see a squeeze up above 82.40, then this corrective rebound will extend to revisit the medium-term pivotal resistance at 83.10. Right, so that's for the dollar Swiss. All right, now next will be the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So what I could see over here is that we do have a negative feedback loop slipping back into the Asia stock indices after the rather hawkish hold by the Fed. All right, so what I could see is that it broke down below our pivotal support level at 23.69, and also right now breaking down below the next support level at 23.600/440. So what I could see over here is that means i.e. from the high of 11th of June until now is now doing a extensive minor corrective decline phase to retrace the entire uptrend movement from the low of 9th of April. Right, so this uptrend here has ended, and right now is doing this corrective phase, decline phase, to retrace the uptrend from 9th of April to 11th of June. But overall, the longer term picture is still bullish as price action continues to hold above the 200-day moving average and the 50-day moving average. So right now, we will flip to a intraday trend bearish bias using the 20-day moving average as my short-term pivotal resistance, 23,690 over here. First resistance to watch in any case of a bounce, okay, will be this level here. Okay, because price action on the hourly RSI is at the oversold level, so there could be a chance of a bounce. Okay, so the bounce will be this pullback line of this former minor ascending channel now turns into a pullback support level, pullback resistance level. Okay, former minor ascending channel turns pullback resistance, 23,480. Two short-term support level to watch on the intraday basis, 23,060. Breakdown below it exposes 22,700, which is the minor swing low of 2nd of June, and as well as confluencing with the 50-day moving average. Only a bullish breakout and the hourly close above 23,690 that would invalidate today's intraday trend bearish bias to see a recovery, at least in first step towards 23,900, and above it sees this Monday minor swing high area at 24,240. All right, so flipping to a intraday trend bearish bias using 23,690 as my short-term pivotal resistance on the Hong Kong 33. Next up will be the Japan 225. So the Japan 225, yesterday we do have a bearish bias at this 38,850. It's already hit the upper limit of this minor ascending triangle range configuration that is still in play. So potentially right now, since the high of 12th of May to the low of 23rd of May, it continues to trade within this 4-week plus of minor ascending range configuration. So no change, 38,850. The upper limit of this minor ascending triangle range configuration that will be still by pivotal resistance level, maintain that bearish bias for a potential retracement back towards the lower limit of this minor ascending triangle range configuration, with the support level to watch 38,145, followed by 37,820. All right, which is the lower limit. Okay, so it's a zone over here, 38,145, 37,820. Only a bullish breakout and the hourly close above 38,850 will open up scope for a bullish breakout scenario, exposing the next near-term resistance at 39,560, which is the 0.318 Fibo extension, and as well as the minor swing high area of 13th of February and 14th of February this year. So that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 broke down of our first support level at 23,310 level over here. So what I'll do is that I will shift down my pivotal resistance by adjusting it slightly downwards to be the minor swing high area on 18th of June, 17th of June, and as well as 16th of 17th of June, 18th of June, and as well as the minor descending channel upper limit that I drew from the all-time high of 5th of June over here. So adjusted pivotal resistance on the Germany 30, 23,510. That will be my pivotal resistance for today, still maintaining that intraday trend bearish bias on the Germany 30. First support level 23,150. Thereafter followed by 23,910, which is the lower limit of this minor descending channel, the 0.618 Fibo extension on the downside, and as well as the minor swing low of 6th of May. Only a bullish breakout and the hourly close above 515, pardon me, 23,515, that would invalidate today's trend bearish bias to see a potential recovery or a rebound, at least in first step, to expose the next near-term support at 23,730. Above it, may see the next resistance coming in at 23,880/24,025, which is also confluence with the 20-day moving average, acting as a similar resistance level as well. So that's for the Germany 30, still maintaining our intraday trend bearish bias with a slightly adjusted downward pivotal resistance at 23,515 for today. Next up, the major US stock indices, starting with the US Wall Street 30, the Dow Jones Industrial Average. So the Dow Jones Industrial Average hit exactly our first support level, the upper limit at 42,020/41,850. So given that it hasn't broken down below this this first support zone, we'll be still using the pivotal resistance level at 42,580/700. That will also be the 200-day moving average, acting as a similar resistance level as well. So still maintaining our bearish bias stance in any signs of any rebound. All right, so first resistance level to watch, right? There could be a potential bounce coming in, will be the intersection between the 20-day and the 15-day moving average at 42,350 level. So if we start to see a breakdown below 41,850, that will expose the next near-term support coming in at 41,530 next. So i.e., in a nutshell, not changing any key levels yet, because it continues to be still able to hold on to the first support zone at 42,020/41,850, but the bias still remains to the bearish side of the story, as price action continues to remain lackluster below the 200-day moving average. So no change, still maintaining that intraday trend bearish bias in any signs of any rebound, holding below the short-term pivotal resistance at 42,580/700. Only a bullish breakout and an hourly close above 42,700, that would start to see the boost coming back into the picture and retesting the 11th of June minor swing high area at 43,085 in the first step. So that's for the US Wall Street 30, representing the Dow Jones Industrial Average. Next up will be the S&P 500. So the S&P 500 also trended downward as expected. Yesterday we do have a bearish bias with the first support coming in at 59.40, which is also the 20-day moving average. All right. So given the fact that it hasn't broken below the 20-day moving average, we will still be not having a tightened short-term pivotal resistance. All right. So far now, we still maintain our pivotal resistance at 6,050 over here for the SPX 500. First support level to watch will be at 59.40. Only a breakdown below 59.40 may expose the next near-term support level at 58.50, pardon me, which is a confluence with the 200-day moving average as well. All right, so right now, first resistance level, because what you could see over here is that there is actually this minor trend line breakdown. If I could link the lows here. Okay, yeah, let me draw a proper one. Yes, this is the one. Okay, this minor ascending trend line break. So the first resistance to watch here, the pullback of this minor ascending trend line at 5995, which is close to the 6,000 psychological level. So first resistance to watch in any bounce. So the maximum will be 6,050 level. So unless price action can have a clear bearish breakdown during the European session, that means an hourly close below 5,940, then I can tighten the short-term pivotal resistance to this 5,995. So everything still remains the same, still maintain our bearish bias below 6,050. Only a bullish breakout and the hourly close above 6,050, then that should skew the bias back to the bulls, instead exposing the next near-term resistance, pardon me, in first step at 6,093 before retesting the all-time high area at 6,151. Right, so that's for the SPX 500. Lastly will be the Nasdaq 100. So the Nasdaq 100 also came close to our 20-day moving average, 21,650 level over here. All right. Also, in first step yesterday during the release of the FOMC meeting, it can't break above our first resistance at 21,890 before twinning downwards much lower. So no change, still maintaining all the key levels, but having that same bearish bias view. So unless we have a clear break below this 21,500, which is the swing low that managed to survive on last Friday during the news flow that was triggered by the Israel attack on Iran, the first attack on Iran, I would say. Levels still maintain the same. So i.e. 22,050 short-term pivotal resistance level, maintain the trend bearish bias in any size of any bounce, break down below 21,500, exposing the next near-term support zone at 21,180/21,030. So unless we have an hourly close below 21,500, then I could tighten the short-term pivotal resistance to 21,890. All right. However, if price action starts to do a bullish reversal, then followed by a bullish breakout above 22,050, the owners shift back to the bulls for a retest of the current all-time high area at 22,200/22,250 in the first step. Okay, so that sums up the intraday technical outlook for the major stock indices. So let us now focus on the key commodities market, starting with the gold XAU/USD. So for gold XAU/USD, price action yesterday can't break past the 3,400 level and going to play around the 3,380 level mark over here. So with that, the hourly RSI has started to broke down below the former parallel ascending trendline support level and starts to shape a bearish reaction of it in today's Asia session over here. So this is actually a bearish observation on the hourly RSI, indicating that there's some form of short-term bearish momentum taking shape on the price action of the gold XAU/USD. And bear in mind over here is that this bearish observation that's seen on the RSI still has some more room to go before hitting the oversold region. That means, i.e., there could be potential downside pressure, at least on the intraday basis, in a very short-term time frame for gold XAU/USD. So with that, I'll be using yesterday's release of the FOMC outcome rejection area at the 3,400 level for the bulls to be my short-term pivotal resistance level, flip to a bearish bias for this corrective decline sequence to continue further on the downside that has been taking shape since the start of 16th of Jan. Support level to watch will be 3,346, which is the 20-day moving average over here. So just a bit of down move more to go before hitting 3,346. All right, so this will be the 20-day moving average, and as well as the the lower limit of this minor ascending channel that is still in place since 29th of May. So if we start to form any bullish reversal candlestick at 3,346, this could be the inflection point for the bulls to resume its bullish up move again. However, if we start to see a long bearish candle breakdown with hourly close below 3,346, then this corrective decline sequence may extend to test the medium-term support zone at 3,320/3,000 302, or the psychological level 3,300 level, which is also confluence with the rising 50-day moving average. Only a bullish breakout at the hourly close above 3,400 that would turn the table back to the bulls again for recovery towards the 3,423, and even a potential retest at this Monday 16th of June swing high at 3,450. So i.e., given the bearish observation that's being seen on the hourly RSI, there could be a downside risk for gold XAU/USD to shape some kind of residual downward move towards the 20-day moving average, and as well as the minor ascending channel support at 3,346, using 3,400 as my short-term pivotal resistance level. Next up, the West Texas oil over here. So the West Texas oil on the intraday basis continues to be bullish. So yesterday we have two support level to watch. The first support level 73.70, pivotal support zone 70.60/69.15. So yesterday upon hitting 75.18 level, price action tested downwards during the US session, all right, but managed to survive at 72.20, all right, over here. So levels still remains unchanged. Unless we have a clear break above 75.18, then I could tighten my short-term pivotal support level to 73.20. So for now, I'm still using 70.60/69.15 as my short-term pivotal resistance. Okay, I repeat again. Still using 70.60/69.15 as my short-term pivotal support level. All right, unless we have an hourly breakout above 75.18, which is the range top or the range resistance that is in place since last Friday, then I could tighten the short-term pivotal support to 73.20. Above 75.18 sees the next resistance coming in at 77 figures/77.60. Above 77.60 sees 79.50 coming in next, which is the 4.236 Fibo extension here. Let me put it in writing. Oh gosh. Okay, 79.15. So if you go back to the 4-hour time frame or the daily time frame, this 79.50 also a graphical resistance level as well. Oops. Okay, which is this minor swing high area of 17th of June. Okay, go back to the hourly time frame. Okay, so only a sudden push down below 69.15 that would invalidate last Friday bullish breakout scenario and see another round of choppy corrective decline sequence unfolding towards the next near-term support level at 67 figures, 67.27, which is corresponding to the rising 20-day moving average. So in a nutshell, still having that bullish bias view on West Texas oil. Okay, before we go, that's also sum up the intraday technical outlook on the major cross asset classes. So right now, before we go, let's have a quick look at the economic calendar. What are the key data to look up for today? All right, so today will be Thursday. So on Thursday at 3:30 p.m., we have ECB President Lagarde speaking. That could influence the euro dollar and the euro crosses, and potentially even the DAX as well. And this is the similar timing. We have the Switzerland Central Bank SNB interest rate decision. So this is where market is expecting it to reduce interest rate by 25 basis point to be 0%. So that has already potentially been priced into the market because there's a high expectation that SNB will start to reduce interest rates. All right. Then thereafter, we have President Lagarde speaking again at 6:30 p.m. Singapore time. All right, then we have another monetary policy decision making. This will be the Bank of England interest rate decision. So for Bank of England interest rate decision over here, market is expecting no change at 4.25%. But will it be a dovish hold? Because potentially it could. Why? Because in the last few months, we start to see a slowdown in inflationary trend, and we start to see also a slowdown in the labor market in England as well. All right, so there could be a potential dovish hold, but things may also surprise for Bank of England point of view. They may start to play the Federal Reserve playbook, turning also be more cautious again, given the fact that they may start to say that inflation trend may reverse in UK due to the global, we call it a rather erratic trade tariffs policy that is being implemented by the current US White House administration. So do watch closely the two key levels that I highlighted earlier on the sterling dollar. All right, so that is 7 p.m. Singapore time today, Bank of England interest rate decision. So then thereafter will be a rather quiet US session. So for US today, it was a public holiday, so the stock market will be closed. All right. And what we have on early Asia session tomorrow before the start of our daily dose will be Japan inflation rate. So Japan core inflation rate market is expecting continues to inch higher at 3.6%, and even the core inflation rate that's excluding food and energy, trading economies will expect it to go higher as well to 3.1% from 3% previously. So that is 7:30 a.m. Singapore time, and that could influence the movement of the dollar yen and the yen crosses. And at 9:15 a.m. Singapore time, we have a PBOC monetary policy decision on their loan prime rate, the 1 year and the 5 year. Market is expecting no change for both the loan prime rate and the 5 year loan prime rate as well. Right, so that is at 9:15 a.m. Singapore time out from China. So with that, that sum up today's daily dose of market insight. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.